is another week, which means it's a happy hour, Ask Me Anything, where we are here to answer all of your questions, Brady Bunch style. So we are fired up, ready to rock. I've got a fresh Nespresso coffee ready to go. So let's get into it after this. Wow, that video went extra fast today. It did. I drinking my coffee. I'm like, whoa, it's almost over. Here we go. All right, so let's begin normal fashion here. We got Mr. Sipple in the waiting room. He's going to throw off our Brady Bunch style here, but we'll bring him in. All right, so let's start with Shauna and go right around. What's up, F-Cat?
Hi, I'm here. It's sunny out today. First day that daylight savings isn't really kicking my butt, so happy to be here. I was sick last week, so I'm feeling excited to be back. So ready to help with Ask Me Anything today.
Stuff. And Mike.
Hello, Mike Samet from Northeast Florida. Beautiful 79 degrees here in St. Augustine.
Hey, Brian Fouch here up in Washington State, but I'm in the dry part of the state, and it's nice and sunny. It's going to be 70, I think, later this week, so I'm excited to be able to get the dust of the old Cougar off and go for some drives. Looking forward to it.
Wait a minute. What year is your Cougar?
67.
Oh, my brother had a 68 when we were kids, so yeah. Got the old lights that flip up. Oh, awesome.
Yep.
Oh, dang.
That's a nice kitty cat. Nice kitty cat. What's your kitty cat eat? Cougars eat meat.
Yes,
yeah. Well, hey, Craig Yenny here from kind of not sunny south of Denver, Colorado, just waiting for the 2 feet of snow to show up tonight. So I'll be shoveling away tomorrow. I'll send you guys pictures, but it's coming. It's on its way. I actually enjoy it. It's going to be fun. But other than that, just been a busy day. So we had a wealth webinar kind of focused on business owners, entrepreneurs, kind of showing how you can use the infinite banking process, becoming your own banker to finance your own stuff. And really at the end of the day, what was the impact of using third-party financing versus using your own system? Well, depends on how much money you want to keep in your pocket. Other than that, it's been a good day, and I'm going to pass it on to my buddy Joe.
Hello, I'm Joe. And there's no snow on the ground, and I'm very happy. So, Craig, keep all the snow because I don't want it. I'm done for another, 6 months maybe?
Chris said he wanted some, so I'm going to have to send it up there.
He lies. I don't like it. It's cold, it's wet, and it does not help me.
Well, that's all right. The rodent didn't see its shadows, so you're good to go.
Woohoo!
There you go. Thank you, Joe. Beautiful day in the city. Beautiful. I didn't mess up the Brady Bunch alone because we brought Carson with us too. So he's here as well. Been working on tomorrow's Founding Fathers webinar. We're going to discuss the power of compounding interest. Did you guys know that Warren Buffett at age, let's say 60 was worth, well, how about this? 81.5 billion of Warren Buffett's $84.5 billion was made after he turned 65 years old. Did you guys know that?
The case, yeah.
That's encouraging, right?
So it's all about the time. It's all about the time, the patience, and the discipline. So over to my buddy Carson.
What's up, guys? Can you hear me?
Yep.
Yes.
Sweet. How you guys doing? I'm out here in California, doing well. Sorry, I hopped in a few minutes late. I was finishing up a call with someone talking about their illustration and teaching them what they were doing with their situation, their numbers for their banking policy. He just sold a massive commercial project, and he was dumping all this profit into his policy before he goes and does the next one. So it's a pretty cool case study. And we get to meet with all kinds of people talking about IBC and banking and business growth. It's awesome. So today's going well. Just coming in. Sorry, a few minutes late, but I'm ready to go.
Wow, this is freaky. StreamYard just said, would you like to try out some experimental AI features. No. I'm telling you, man, that Terminator's coming in hot.
I say yes. Why not? Let's see what
I'm
happens.
gonna say yes. All right.
You can take your risks, and I'm going to take mine, and I'm not taking the AI risks, man.
I've got one pre-submitted question. I know Chris is going to hop off a little bit earlier than the rest of us, so I'm going to get this one out now. So Mike is asking, what happens if you use your self-directed IRA to purchase an investment property using the BRRRR strategy? What happens when you get the refinance part of the BRRRR in regards to where the money goes when you refinance? Can you refinance it to pay back the self-directed IRA and now collect money for rent directly instead of having it go to the self-directed IRA? So it is a good question. It's kind of complicated, but yeah.
It's a really good question because it's something very similar to what I did. It wasn't a BRRRR. I had bought a property to rehab up in Buffalo, and I used my self-directed IRA. I ran out of money in the self-directed and couldn't get money in it fast enough because of contribution limits that I ended up having to go to a bank and refinance it. So contrary to what you may believe, that is a taxable event. So every penny that you paid for the property with your self-directed IRA will all become taxable. It'll be a distribution from your IRA. Now, I could be off. I'd love to almost refer you over to Horizon Trust to get the solidified answer. But I know when I did it, I was working with the folks over at Horizon Trust, and there was no way around it. I mean, either your IRA owns it and funds it and pays for everything with the property, or it's a distribution from that. So I think those are the only two ways.
I love it. And I do think your advice of going to Horizon is probably the best. And then as Uncle B-Rad says, disclaimer, this is not financial advice. We've only got about 1 or 2 questions in queue, so give us your questions. We'll start with this. Casual Credit Gaming. Afternoon, everybody. Question. A few streams ago, Chris and maybe a couple others spoke about 10 pays being part of the conventional whole life thinking and not really suitable for IBC. However, I've understood it is that the IBC use case for 10 pays is a place to land windfalls, as in money that's from a settlement, for example, that's a 10 to 20x your realistic income. Thoughts on using 10 pays for, not that sustainable income that you can rely on? I guess that's a good question.
Yeah, it's a good question, and I think a couple people can comment. I've used 10 pays maybe 3 times in the thousands of policies that we've done for IBC. And the sole reason why I don't use 10 pays is, a 10 pay, what you're doing is you're condensing all of the cost of insurance in 10 years. I mean, the insurance company's not giving you a flyer for the rest of your life. They're just packing the cost of insurance in a 10-year period, or whatever the pay period is. We'll just use a 10 pay because those are common. So it affects the performance of the policy in those early years. Now, after the 10th year, what happens is all cost of insurance stops. And then it's literally a tailwind from 10 years on. But the problem is just like any policy we will ever design, 10 pay or not, by the 10th year, your policy's in a really efficient point where, like, literally every dollar you put in, you're getting $2, sometimes maybe $3 for every dollar you put in. So in a 10 pay, a true 10 pay, if you do that in the 10th year, you can no longer put premium deposits in for the rest of your life. Okay. So 10 years, you're done funding the policy. Now, if you front loaded it with a settlement or something over the 10 years, or used a fixed income or a fixed period income annuity to fund those 10 years, there's lots of different strategies we could use to take a life settlement or a settlement and then break it up over 10 years, fund it, and then be done. In that scenario, it could work. But in general purposes, you want the ability to put money, new future deposits into your policy for the rest of your life, because as time goes on, the policy gets more and more efficient, which is literally like printing money. I mean, you're putting money in and you're taking way more out than you're putting in. Why would you ever want to stop putting money into that? I'll let everybody else comment.
Yeah, so I guess, Chris, what I would add to that, why is that question being asked? And I think when folks I've talked to, why they ask me about that is they don't want to pay premiums beyond a certain point. And don't be misled, because the 10 pay, yeah, you're paying for 10 years. But if we had a 121 pay, a lot of times that's what we're setting up, where you can pay it for 121 years. It doesn't mean you have to. At some point, you can use the dividends to pay the base. You can squish it down to the base only. So there's a lot of other things you can do if you don't want to continue putting money into the policy. Or I guess I would put it this way: if you can't. If you can, then you certainly should do it, because I don't know of anybody that if they gave me $1 and I gave them $5 back, they'd say, I don't want Craig coming around anymore. So just kind of think of it as, even if you have a policy that we design and you don't want to pay after year 7, well, there's things you can do to make that happen. It's not optimal, but you can make it happen.
Yeah.
They might.
I have a follow-up question too to this whole scenario. Go ahead, Joe.
I had a 10 pay come up yesterday, where somebody sent me another policy illustration from another insurance company. And so I've come across 10 pays where another agent that is not IBC focused is trying to do IBC for their client, and they're doing 10 pays thinking that's what the client wants. And so yesterday, the client sent me this one and said, hey, the agent was comparing your illustration to theirs, which is a 10 pay. And they said, well, you had more cash value in the illustration up front, but in year 10, theirs caught up. And they're saying, well, why is that? And this, my response was this, and I want to get feedback from the group here as well. Well, it's because they're shoving all the value into the policy within 10 years, whereas we're doing it for your entire life. Mm-hmm. So you're only looking at a 10-year window. And so, yeah, it might catch up, but guess what? That's in year 10. But what about year 15, year 20 down the road, where mine is just continue, the one that we build for you, to continue to have more cash value, growing exponentially more. They don't have that. It's not even an option. Yeah. It's done.
But Brian, in a case like that, I would always go to the client. I would say, what was the opportunity cost in those first 10 years for the money that you didn't have available during those years? Like, how much did you lose by not having extra money to deploy in those first 10 years? Yes, it might catch up in the 10th year, and that your answer is right. But it didn't catch up, because if you were using this for IBC and you were taking money out right in the beginning, the 10 pay is not going to have nearly as much cash value as a regular one we designed. So you could deploy more money, get more money working out there. Just pick on like the Fuller deal at 12 to 15%. Like, how much income or revenue did you lose in those 10 years by not having access to more money because your agent said, oh, but in the 10th year it catches up, and then you no longer have premiums? It's like, dude, I want premium deposits.
Exactly. Yeah, and that's what I explained to him. I says, well, what are you doing with the money? You have $5,000. Yeah, it's $5,000 more in year 1 cash value. What's that $5,000 worth to you? Because I knew what he's doing with it. He's doing a policy with us, by the way. So he's not doing the other one, the 10 pay, because it didn't make sense once he saw the comparisons and saw the future value and where he could borrow year 1 through 5. It just made all sense, because I said, this is infinite banking. We don't do 10 pays. We just don't. So.
Yeah, I mean, we do 10 pays. You could. It's just it doesn't make sense. Like we all of us could do a 10 pay. Every company we work with has a 10 pay. There's nothing wrong with them. It's not like we're not comparing a whole life to an IUL. It's just the mathematics don't make sense of a 10 pay for what we do. I'm not saying they don't make sense for everything. Like, this individual might just have a settlement that they're trying to get into the policy all up front. Right. And then maybe it does make sense for that use case, but we'd have to jump on a call with them and figure out, like, does this solve the problem you're trying to, or should we do a 10 pay? And we certainly could. Yeah. It just usually won't make sense for what we do.
I mean, mathematically, like everyone said, it always makes sense, right? But you're removing the choice. I mean, basically, the bottom line is you're removing the choice completely if it's a 10. Yeah.
Yeah. So what would be the, like, so let's say this person did call and they understand IBC, they know that a 10 pay is not realistic for IBC, but they do have a settlement coming, and maybe that settlement's trickling in, like they said, over the next few years. Like, what would you suggest? I know sometimes we talk about, like, what would the alternative to that be? Like, let's say they're on the phone right now. Like, okay,
I did that one actually.
Yeah, instead of a 10 pay, we would do a dump in, or what's the realistic thing to say?
So the one I built for someone that had that scenario. It was a multiple dump ins. So it was 1 per year. They said, hey, this is what I'm going to get on the settlement. It's this much over time. So we built a policy where they can do multiple dump ins on a yearly basis for the first 5 years. So I think it was like $50,000 a year, something like that. Mm-hmm. With I can't remember the premium of about like $10,000 premium per year.
10,000 premium. That's good. That's a good example. So I like that. So yeah, like what Chris said too, is just get on a call. Know that option that Brian just proved it. He just did it with another client. So definitely talk about that situation, because we have those come across.
Yeah, that's a great one. And that's one that we could show both ways, and you'll just be able to mathematically answer your question and solve for your problem. I mean, that's the beauty. And like, this is what Craig's kind of made his entire, like, name on, is like mathematically proving a scenario makes more sense. And then if you go against mathematics, I mean, I don't know. I mean, hey, maybe you're smarter than math, but I guess Elon doesn't know anything. So you're smarter than Elon. You should probably just not even do anything, but just create something yourself.
So Tony's got a question here. Can you pay for the PMC yearly fee from a self-directed IRA? And I do know an answer to that is you can, yes, if you are in the action of rolling over. Like if you're about to roll over to Horizon Trust, in that rollover period, we've had people in the past pay for their first year, but it's kind of like all in one. Like they're rolling it over and then they make that purchase, I guess you would say, from your self-directed IRA. So I don't know the answer if it's already an established self-directed IRA.
I think you could if it was education. So if you were buying a certification, so to say, and in that certification just came a membership, then I think it would qualify, but you'd have to be very specific.
Yeah, so I'd say you can check with, if it is Horizon Trust custodian, I would check with them. They'll be able to give you the exact answer. But in the past, we've definitely had somebody pay for PMC as they were rolling over a self-directed IRA. However, that next year, though, you'd have to pay with like a credit card or something like that. So D Kaiser saying, trying to get a policy in place for my wife, 60 in good health, but when the gal came to do the physical last Friday, blood pressure was very high. We are in the middle of stressful tax season. Now what?
This actually happens quite a lot more than you think. Believe it or not, there's actually people that are like deathly afraid of getting like stuck by a needle. Like they're in their blood pressure skyrockets. This is actually a normal thing, but I'd almost wait and see what the insurance company says, or have the application specialist or someone put a cover letter with it explaining like why blood pressure could be high, because, you know, you're CPA or what, I don't know, but you know, you're dealing with the most stressful period of time and things were rough, and you know, though they maybe will retest, or worst case, here's what I've seen happen. You take the issue, even let's say it's, you know, you think you're going to get a preferred, but you get a standard because of blood pressure. Then after the policy's issued, you petition the insurance company with a cover letter to them stating you'd like to retest. Usually they won't do it right away, but sometimes 6 months or 1 year down the line, they would retest and you'd be fine. I've had smokers do this. I've had all sorts of people retest and get positive results from it. You're not going to miss out on much. I mean, high blood pressure isn't going to, I mean, how high was the blood pressure? I mean, was she literally bright red like a tomato? But I mean, depending on the severity of that, you'd probably have good success doing it that way. And you're not going to miss much by getting like one lower in rating over the course of a year.
All right. Tracy's asking, if you bought a home in late 2018 for $160,000 and it will now sell for about $300,000, what are the tax implications when I sell it?
I can't give tax advice, but if as long as you've lived there, what is the rule now? Is it 2 years still?
3 of the last 5, isn't it?
3 of the last 5. So if they live there 3 of the last 5 years, then there's no tax implications for selling it if it's your primary home.
Yeah.
Do you remember the good old days when it was just 2 years?
Yeah.
What's that, Mike?
Yeah, 250 exclusion for single, 500,000 for married. Again.
We're not giving tax advice. Consult your CPA.
And I think you can also, if you've done any improvements on that 160, I mean, if you put 20 grand into the house, make sure you save those receipts. Not a CPA, not giving tax advice, yada, yada, but you can add those improvements to the basis of the house as well. So that'll help.
Love it.
Correct.
George is saying, which I think this is a really interesting question. So George is saying, could I, as the insured or the beneficiary, but not the owner of a policy, make premium deposits / loan repayments directly to the insurance company from my personal bank account?
Not the beneficiary, the insured. Well, that's a good questions today. Challenging questions.
I know. I never heard this one.
When I moved my policy into the trust has to pay the policy.
Yeah, I think that would be the case. The owner's always going to have full control, but you might be able to get like a letter or an approval from the owner to do that. That's a really good question.
I know that my personal,
I'm embarrassed that I can't answer that.
My personal can't pay my policy anymore. It needs to come out of the trust. So
yeah, I think
I've had someone that's not the owner, I believe, pay the policy, like a father on a son that was an adult, and then they're going to change ownership. But I don't know the answer to this one.
But I think in this case, like the insured could get permission from the owner, or worst case, the insured sets up an account with the owner, like a joint account, and then just sends the money to the joint account, and then from the joint account, the insurance company sweeps it.
That makes sense.
I don't know. That would be, I think, the best path.
Yeah.
Almost like setting up a segregated account that the owner and the insured both are co-owners of, and then just the insured's just funding it. I mean, it would be all the same. I got to jump, though, unfortunately. I got to jump on my next webinar. 5 webinars today.
Have a good one.
All right.
Webinar Wednesday. Look at that.
I don't know. Is this, Shauna, can you take over host? Because I think if I cancel, it won't matter, will it?
I think you can leave, right? Or does it say end stream, or just at the bottom of the screen?
It says leave studio.
Yep, do that.
Hey, Chris, before you leave, did you need me at the tail end of this to be on that meeting?
No, I don't think so. I think I got this one. This is just an intro with Mark.
Okay.
All right.
All right.
Thanks.
Bye.
Bye.
Let's hope for the best. We don't get unplugged right now. Oh, we did it.
We're all here.
Joey's in the middle.
Joey is asking, I have a question for the team. Is there any of you that are legal to write HECV policies for Maine residents? I want to connect a friend with you, if so. So the good answer is most of us are, not me, but most of the people on this call.
All of us.
Yeah. So the answer is yes. I'm actually going to put the link in the chat. You should be able to, as long as they kind of, we don't want to say they have to do a couple steps first before they get on the phone call with the team. We want them to like be familiar with IBC, because that call is really to figure out, how it's going to work for them and their goals. So make sure that they're educated on the subject first before, plugging them in. But when ready, they just go to mentors.beyourownbanker.com and they will get connected with anybody on the team to pick up the conversation from there. Tracy is asking, can you buy IBC policies for little kids using their age for the premium?
Yeah.
Essentially. It'd be small, but yeah.
It goes after the parents, though. The parents have to have a policy.
Yeah.
Okay, yeah. So the rule of thumb with kids policies that I know of is that they're able to get 50% of the coverage that the parents have. Or up to, yeah.
Yeah. And it's all kids at the same time.
And no favorite kids.
Yeah, no. If you have 2 kids, you can't do one and not the other. They prefer to have both kids insured at the same time. So.
And I think the only exception is if they're like adult children, correct?
Correct. Yeah. Sorry. Yeah. Juvenile.
I mean, but if they're saying like little kids, are we saying like 2 years old times 10, $20 a month? I don't know if that's
would make sense.
Well, it probably wouldn't even work because there has to be a minimum death benefit of about 25,000. So we'd have to back into that number. So
that's, I just wanted to make sure that we answer that question correctly.
Yeah.
So it needs to be a certain amount.
Yeah.
I mean, realistically, I think it needs to be probably in that 200 a month range, maybe a little bit less, but somewhere in there is probably where you're going to hit that minimum that minimum death benefit.
It gets really, really, really hard to design when they're less than that. Like I spent 2 hours designing ones here. I could look on my sheet because of the maximum coverage on the mom. Hold on. It was 650 annually and 550 annually was the most coverage I could put on them for the kids. But she just wanted the kids protected. I don't know if she fully understands IBC yet. So I thought she's super young. So it was a good step. But I'm telling you guys, it took me almost 2 hours to design those because it kept meching just for the small amounts like that. So, yeah.
What's this mech thing you talk about?
Modified endowment contract. Turns into you have a government as the partner. That's all.
So an ideal situation would be like, let's say there's 3 kids, $200 each a month policy, so long as that coverage is under 50% of the adult. That's like the kind of, I don't want to say perfect case, but a nice cookie cutter case to work with.
Maybe like that, yeah.
Starting.
And to give you an idea, like, I mean, this won't give you the answer, but if like it's a 4-year-old and the parents have 1.5 million, so they could go down to 750,000 total coverage for the kid. That's like $5,000 a year. I know because I just literally did that a few minutes ago. So, like that's kind of a maximum amount. So, like Sean is saying, 2,400 a year is going to be probably $500,000 or a little less, depending on how young they are. So,
yep. And then here's kind of like a follow-up comment, like that's good to know. I have 2 kids under 18. I already have mine started, but wanted to get their started on theirs after a year. But yeah, just plan that you got to do both of them at the same time.
Yep.
Can you do different amounts?
They have to be within 15,000 death benefit. What's that number?
Close.
So
I'm not sure what the exact number is, but they need to be pretty similar in death benefit numbers.
Okay. All right. All right. This might be for you, Joe. So Finance One is saying, I have a question about the all-in-one loan. What are some basic requirements to be approved for this product?
700 and above gets
sorry, follow up. I recently bought my first home in February through seller financing, where the seller has a $178,000 mortgage at 8%, and I pay $2,000 a month.
So up to 90% loan to value. So 180 would get you about 150 or so for the line. Credit score needs to be at least 660 for 40%, 700 for 45%, and the rate is 7.75 fixed for 5 years, and that's simple interest. That's about it. And if you get a hold of me, we can run the numbers and see what other debts you have. But DTI needs to be 45%.
I don't know if this is a silly question, but because they bought it through seller financing, like how do they go about getting like a HELOC? If it's seller finance, does that mean that the other person's still technically holding the note?
Yeah, so they would just go to the bank saying they want to buy this. They want to buy this house, and it'll be taking it over.
Okay, so
it's a refi. It's like refinancing the whole
okay.
Refi.
Okay, so basically you're wiping out that seller finance situation.
That's what they would be doing, yeah.
All right, cool. George is saying, if I sold the house to an individual with a 30-year owner financed mortgage, would that qualify as an insurable interest, and could I own a policy on the buyer?
I believe so.
Yeah, that's a good question right there.
George, you got my mind thinking. I'm like, maybe we should teach people to owner finance their mortgages and then take policies out on their people buying it from. That's hilarious. I don't know.
Yeah, you have an insurable interest in that person because they owe you money.
Yeah. Interesting.
I like that one. All
right. And then this is our last question right now too, guys. So B-Rad is saying, when is the next virtual ticket event? So the next virtual ticket event is for Private Money Club specifically. It's April 26th and 27th. It's the Money Tank event. It's also a live event. So you can go live to Salt Lake City, Utah, or you could buy a ticket virtually. And then the next live event we have is in the beginning of April. The Orlando experience is, I believe, April 11th through the 13th. And you can definitely email me if you would like to come. And I'm going to put the round robin on the screen once more while we wait for a few more questions to come up. But mentors.beyourownbanker.com. All of our agents are pretty much licensed in all 50 states. So wherever you are in the country, we are able to serve you and yours.
And what happens on that mentor call? If they book a call, what happens?
Well, yeah, let's go over a few things first. So what should happen first?
That's a great question, Shauna. You brought it up earlier too. I mean, you said if you're going to meet with us, you almost have some homework to do. We want to make sure you understand infinite banking, at least the basics. You understand what it means for you, what you're trying to get out of it. And then once you come to the call with those in mind, awesome. Let's have a great conversation about you, your questions. Make sure you understand the concept, understand what you're trying to accomplish. That's the goal of the phone call. And then we can dive into some numbers, what kind of premiums you're looking to have, what you don't want to be putting into the policy consistently, maybe there's a dump in, maybe there's not. We can dive into that too. But I mean, that phone call is just to kind of figure out what you're looking for and see if this does make sense for you.
Yeah, the best use of your time is to know, one, if your goal is to tackle debt, kind of know, take your head out of your butt, make sure you're figuring out what those debts are, tally them up a little bit, and then get, so you can make that game plan. Or
I'm not expecting that, Shauna. No one.
Yeah. Well, I mean, I know that when you are struggling with debt, sometimes you don't want to really look at it fully.
Yeah,
so
progress starts with being honest with yourself, is what Shauna says.
Yeah.
Okay.
Yeah. So that's a good thing to know, because then they can kind of reverse engineer how to get out of that. So, and Craig's got a tool that really can amaze you with, if you're doing it the old traditional way, it might take you, who knows how long to get out of that debt, but we've got tools and systems in place to speed up the process. And then, like, let's say your other goal would be you just have money, or like a windfall, like that person was talking about. Maybe they're coming into stuff. Like, what is it that you want to do with that? Like, have you been around the campfire enough to know about opportunities, know about Private Money Club? We're all happy to help you there.
What I would say, to add to it, no one said anything about the Money Multiplier presentation, right? So before you're coming to the call, you are fully watching the Money Multiplier presentation. And then the mentors are going to reach out and provide additional things if you want. And we can decide, figure out where you are in your journey, if you're building wealth, keeping wealth, or creating more wealth, right? And the call really, our whole system's super simple. Chris says it all the time. We're going to give away our best stuff for free. Education, shows like this all the time, right? We're constantly looking for new ways of languages, teach this, because at the end of the day, this is a complete paradigm shift, and it's really having you take radical ownership of it, because it's a lifestyle change. This is like deciding, hey, I'm not going to eat bread and sugar anymore, ever, right? This is a complete lifestyle change. And then our call is, like Carson outlined super clearly, it's all about you. Where are you? Where are you financially? Where are you mentally? Where are you on your journey for IBC? We're going to meet you there. And then we're going to talk to you about, what are you trying to solve? One of the questions we all ask is hey, by the end of this call, if everything was answered, what would you feel like? What would that look like? What did we figure out? What do we solve for you? And we'll go through that way. So on the call, you have two choices. We're either going to give you a ton more resources because you're not ready, you're new, and you're still learning. You still think it's too good to be true. We all thought that. Show of hands, anyone who thought that? Too good to be true when you heard about IBC? No, Joe didn't raise his hand, but he was the biggest pain in the ass ever. So I've heard that story a couple times. So
it only took me 16 months. Come on. We're good.
And then if you decide, hey, it is time, it is solving my problem, I do want to make a lifestyle change, I want to get on the backwards bicycle, you're going to go through a 4 to 6 week, application period where it takes the whole team to help you. And then once approved, The third piece is the reason I partnered with the Money Multiplier. Because if you have knowledge, you don't know how to apply it, is it very powerful, right? So you get the implementation team where they're going to basically hold your hand, show you how to take out a loan, pay back the loan, do all the things. And by the way, this is all I do. And I've screwed that up twice because I haven't reached out to the implementation team. Like I had $76,000 floating around the ether because I filled out a wire number instead of a routing number.
Oof.
And another time I didn't get my policy loaded, I forgot to put my social security on the request. And I didn't see the email because I have like 70,000 unopened emails. So it took like 2 weeks before I followed up saying, well, this is too long, but both are my fault. So that's implementation there.
That's a good point, though, is that Jason is not only there to connect you and set this up for you, but he's a consumer and a user of infinite banking too. So we all are, and so we all can share. Just disclaimer, like Ask Me Anything. We're not telling you what to do with your policy, but we all have our own policies. We can share what we're doing, the things that we've accidentally messed up, like forgetting to open an email. Like we are all the same.
Definitely watch the presentation, write down any questions. As Brent says, a short pencil is better than a long memory, and we will answer all your questions.
I always write that down when I hear it, but I've never said it before. I think I'm gonna start saying it.
All right, we do have one more question that came in right now. So Frozen State Productions is saying, I just turned 60, waiting for a large payout to get settled in the courts. I want to set up a policy for home repairs since the insurance company won't cover it, and then pay off credit cards as well. So
Awesome.
60 years old, got money coming in, and has their goals. Like they got home repairs and credit to pay off. So
this one sounds familiar. I'm not sure if this is one of my clients, but I had a very similar client here this week that they're having a big settlement coming in the next few months, and they want to get it into a policy first and then bring it back out into the debts and into, I think they were doing something with their home. I can't remember. So this might be the same situation. But yeah, we mapped it out. We looked at the numbers, looked at the illustration, and yeah, it made sense. It makes a lot of sense for that kind of stuff. And then we're going to map it out. Like how do we borrow from the policy to do the home repairs, pay that back, and then do the credit cards as well. And in reality, I think they might actually end up flipping that around where the cards will be paid first to recapture that cash flow. So that cash flow is not going out to the cards and then go into the home repairs. So it's just mapping out how this is going to work and then understanding the mindset around this so that we understand, okay, I'm thinking differently about money. I'm thinking differently about the situation, the scenario, and how I'm going to do this, because we've all been taught and programmed from a young age to think a certain way about money that makes other people rich. And so it's a 180 for a lot of people when it comes to infinite banking, because you're taking that power back, but some people have never had that power. And so we've got to be responsible with it. And that's really what our whole team here is about, is helping you be responsible through knowledge and the resources that we have. So that's a cool scenario.
I love that. I love how you just put that too. All right. Anything else, guys? We got 13 more minutes, no questions pending.
We can make it 3 more minutes unless someone else pops in or someone else has something interesting to share. I'm sure we could go use the time to go help someone else.
Yes. Mine might be helping myself clean.
I might be eating. I'm answering the one about the children's policy right now, just going through it with someone. They want to put more. It was pretty elaborate planning. It's a pretty interesting case. I'll share with you guys really quick. It was someone who, the gentleman's in his mid-60s. His wife's 30 years younger and doesn't have a policy yet. He has about $1.5 million coverage, and they have a 4-year-old together. So he's looking to protect. It's a whole protection piece and the income piece. It's super interesting. But he wants more coverage on the daughter than the $5,200 will give. He wants to put in more, but he doesn't want to do more on him yet or cover the wife yet. So it's like this back and forth, like that's the max, because that is, there's not a way around it. So it's been hours and hours of planning, and for now we're stuck on just maybe showing him that works for his daughter. I'm not sure where we go from there. So
thank you for sharing. We got a couple more questions that are coming in right now too. So
that was just
interesting one.
So.
Ramiro saying, hi, I do not have a BYOB policy yet, but would like to get one. But I'm confused on when you take out a policy and then take out a loan from or against the policy and make payments that are and make payments, are those payments part, and they said, of the premium? So policy loans and premium payments are definitely two different payments.
Yeah, two separate things. Treat them separately. That's the way I always explain it. Is one is you're funding your bank that then allows you to do the loans. So they're separate things. And the thing about the loans to keep in mind is you control the loans. Like when you pay it back, how you pay it back, how much you pay it back. That is you control that. You want to make the premium payments though. And so another question we get that's very similar is the interest you're earning on the deposits versus what you're paying on the loan. Well, one is only if you borrow the money, which is the loans. The other one is never stops. So, yeah, you treat them as separate things, and we can walk through that on a call to better explain it. But yeah, separate.
Yeah. And then he's saying, I have $10,000 to start a policy to pay off debt and then start investing, and that's a really good, healthy number. Hold on, I lost my spot. So Facebook's user saying, a friend of mine is an electrician. He's 25. How can they use the policy to help grow their business? So business uses, I know you talked about, Craig, a lot. So let's think this
Yeah, so the wealth webinar today was focused specifically on that. So we talked about, if you're a business owner, how can you finance equipment? How can you finance the things you need for your business? The wealth webinar typically is up like about 3 to 5 days before it's posted on the YouTube channel. Is that correct, Shauna?
Yeah, it'll be up on Saturday.
Yeah, I don't know if you want to post that link in the chat, and then what I would do is have your friend watch that wealth webinar that we did today, because we specifically go over how to set up a banking system of your own, how to capitalize it, and then how to finance things that you need for your business and pay your system back. So, I mean, the spoiler alert is this. We showed an example. It's loosely based on a client that I'm working with. It's got a junk business. So they drive the junk trucks around, pick up trash and rubbish and whatnot. The thing is, if they can buy more trucks, they can make $300,000 to $500,000 more per truck. So why wouldn't they want to finance more trucks? But if you finance the trucks through a bank, every time you do that, your money's gone. Every dollar that you finance through the bank, it's gone. So what we're teaching is capitalize. It takes some time to capitalize, and then start using that policy to fund the things that you need for your business. So if you're an electrician, you probably need a truck. You need supplies, you need tools, wire cutters, the whole bit. So how can you start to finance some of that through your own system and then recapture back into paying the loan back? And the key to this would be, if you were to go buy a truck for your business, how much would it cost? What would the bank charge you? Let's say they're going to charge you 9%. If you have a policy and it's charging you 5% loan interest, still pay your system back 9%, because what you'll end up doing is paying off the policy loan, recapturing that money into your system. The rest of it goes into the premium bucket. So that's the whole gist of what we did on Wealth Webinar today.
I love it. And I'm actually, I was asking ChatGPT what what kind of expenses an electrician business owner would have, and yeah, like he's got gear, travel expense, safety gear, permits and inspections, vehicle maintenance, training and education. Let's see, marketing, office space rents. So there's a lot of things that I think fall into possibilities that a policy could help with.
Yeah, it's kind of near and dear to my heart. So my mom's side of the family, over 100 plus years ago, they started a business in Hastings, Nebraska called Guarantee Electric. It's been in the family, just keeps getting handed down. So it's electrician business. My dad worked there, my grandpa run it, now my cousin's running it. So it's really cool. But
Love that.
Not many 100-year-old business. That's pretty awesome.
Yeah, it's a family relic.
I love it. So Nico the Unicorn is saying, can you get an IBC policy if you had a Chapter 7 discharged over 2 years ago?
2 years is the threshold, I believe.
I don't know the answer off the top of my head. So
Depends on the company.
12 to
Some are 1
24
year,
months.
some it's 2, but that should be okay.
cool. So it should be okay. Facebook user says, can we get additional policies? We already have 2. We have 2 already.
Depends on how much coverage you have. So
Depends on how much your body is worth. Depends on how much you make. Depends on your net worth.
And your age and your health.
And what do those existing policies look like? Do you have big loans in them? Are you fully putting in premium on those? So that's a great question to schedule a call with one of the money mentors and just kind of noodle through it.
Yep.
But it's definitely not off the table. It just depends on a few things, and it's definitely worth getting on the phone to figure out.
Or get another body to insure.
Mm-hmm.
Sell a home.
Facebook user saying, in your experience, why do so many people choose to purchase term versus whole life when they can afford either one?
Because they don't know the difference.
Knowledge, bad advice, or just other advice. Take your pick.
Anybody that talks to us after kind of switches the other way.
Michael Turley, I was freaking thinking about you over the weekend. I was sick though. I just you crossed my mind. Been thinking of you, Michael. All right. We got another question, which I don't know if we know the answer to, but when requested for a max loan, I didn't receive entire available balance. What might be the reason? I do know that when I'm looking at my dashboard, like if I'm for my Mass Mutual policy, it'll tell me what my cash value is, and it's some number. And then if I scroll down the page a little bit, it'll tell me I can take out this amount of a loan. And sometimes there is, a slight difference between cash value available versus what I can actually take. Do we know why?
It's usually
why that is?
about 90% of the cash value is typically what's available for a loan. Some in that ballpark.
That makes me happy. That's what I was thinking. Thanks, Craig, for kind of confirming that.
Does that have to do with the way they accrue the interest?
Yeah, I don't know the exact reason, but I do. But 90% sounds right, and then interest. And then in the chat, you guys, there is the playlist for the Wealth Wednesday webinar replays. It's live on Wednesday, and then pretty much between Wednesday and Friday, it gets edited and uploaded and published on Saturday. And then Tracy's asking what other webinar did Chris do? He's doing a podcast interview, so it's just a closed circuit. He's not really doing anything that anybody else could be looking at.
But if you're looking for a webinar, come tomorrow, 3 p.m. Founding Fathers, and we'll talk about the power of uninterrupted compound interest and 5 different recession-proof vehicles. We'll go through those, and then we'll compare them. So we'll have some fun.
Love it. May is asking, as grandparents, can we get a policy on our granddaughter even when their parents don't have a policy?
It'd be hard. Maybe.
And really little.
Would it make sense so if they're the grandparents and the parents are obviously their kid, probably, would it make sense to get a policy on the parent with their child, their adult first? I don't know if
that first.
The parents have to do it themselves based on their income and all of their factors, variables, et cetera, and stuff. So it'd be more of an education. Maybe you could buy, your children the Becoming Your Own Banker by Nelson Nash, and maybe have them watch the 90-minute video and start there with some education.
And are the parents insurable?
And Nelson Nash actually lays out a plan because he was in the Forest Service, so he kind of talked about how they plant trees, and so the way he would describe kind of the multi-generational family policies is the grandparents would get policies for the grandchildren. The parents would get policies on themselves, and it just keeps hopping generation to generation. But the parents definitely should have some policies, and then that would allow the grandparents an easier path. Like Carson's like, it'd be hard. It would be easier for them to then get them based on the parents' coverage. So.
No. All right, Facebook users got a great question. What does it mean when you say I put $1 in and get 4 out?
All right, Mr. Money Tree. Go.
It's the money tree. Explain your policy. It'll be easier that way.
Who, my policy?
Yeah.
Your 15-year-old policy.
Basically, what we're measuring on that is when you make a premium payment, a premium deposit, I should say, not a payment, premium deposit. Let's say you put in $10,000. When does the cash value exceed 10,000? That's what we call, dollar for dollar. So if I put in 10,000 and my cash value grows to 11,000, that means I'm getting $1 plus something, whatever the math is. As the policy gets older and matures, you're going to continue to put $1 in, get $2 back, put $1 in, get $3 back. And depending on how you're funded and set up, I've got one of these older 4% guarantee policies from back in 2008 or 9, whenever I started it. I put $1 in, I'm getting almost $6 back. So it's pretty wild.
What I love about your policies too, Craig, is like everybody else on this call who started a policy for any reason, they had a reason in their mind at that time. Like you started those policies to pay for your daughter's college. And now, what'd you say it was like from 2008? Now your policies are able to have different jobs and do different things because it's infinite banking and infinite things that you can use your money for.
Absolutely.
And we got 2 more questions and then we're going to call it a day. So Stephen and Michael are our last question. So Stephen's saying, does having term life insurance through your employer affect how much death benefit or cash value you can get with the BYOB policy? I think it helps, right?
No, they don't consider that because it's transient if you want to look at it that way, because if you leave that employment, that policy's gone. So they typically don't count that against you.
All right. So unfortunately, it doesn't help.
It wouldn't help. Sean, it wouldn't help. Like if you were trying, it would limit you. Like that would be a limiting factor, right? If they did count the term, like you'd have to make the decision. Do I want to replace the term? Is the term doing what I need it to do? Is it doing its job? Like that would be the question if it counted.
Okay, so mainly you can just start your infinite banking policy and just kind of disregard that is the other question, right? Or the other option.
Yeah, they're not the owner of that employer policy.
Okay. And then last question for today. Michael is saying, when most people are trying to set up these bank-like policies, do they put in lump sums or pay into overtime?
If people have enough of money in their account to do an annual, that would be more advantageous because then you would be getting the dividends and interest from day one. If you were to do that same policy and put in $1,000 a month, well, you're only getting dividends and interest on the amount that you're depositing at that month rate. So you would actually be making more money by putting in more money in the beginning.
Well, it looks like we have a naysayer. Our good friend B Wise as Serpents is calling this a Ponzi scheme, but I don't know. I've been doing this for 15 years. I guess I'm running quite a Ponzi scheme here, but
oh, you're better than Bernie Madoff, who was running a $25 million business before he decided to, do what he did.
I don't know if he's calling us a Ponzi scheme or if he's saying Federal Reserve notes are not a good representation of wealth. So I don't know if he's talking about that.
Yeah, that's fine. Yeah. But yeah, it's interesting because when we talk about these things, it's just simply where we're storing our money before we go do something else with it. And to me, that putting $1 in for 6 is pretty crazy. Well, it can be suspect if you want, but that's the way it is, my friend.
Yeah, good point. Actually, you're right, Craig. He was saying that that's a Ponzi scheme.
All right. Well, here's the deal. In one of those policies, I put in $4,700. That was my base for the year. It grew over $30,000 in cash value.
That's awesome.
Do the math. I mean, I don't know. Maybe I'm telling you the wrong thing, but
wherever B-Wise lives, he does different math. But it depends on the policy, depends on the design, depends on a lot of things, right? Like I know Brent, who also has a 15-year policy, right?
Yeah, it's only 4, right?
He talks about he's putting $1 in year 15 and it's giving $2.55 he can take out as a tax-free loan to use. So It's going to depend policy, when it was designed, how it's designed, how much money is going into it. So there's a lot of factors, and that's why it's specific to each person. So
love it.
Well, we've done some designs, which is pretty fun, where we do really, really big dump ins and small premiums on that 50-50. Joe kind of blew the cover off on this one. And you start looking at the cash on cash on those in the later years, it's phenomenal. I mean,
Crazy,
you get down to your 15, 20, it's in that 6+. So it's pretty wild.
Yeah.
Uncle B-Rad. Yeah. So I'm waiting for an image to show up on social media at some point with driving.
Yeah, those make my day. I don't know, edits that he makes on the Facebook group. But we'll close it out with our new curse word, holy spreadsheets.
great questions today, y'all. It was a lot of fun.
Yeah.
Absolutely.
Right.
Till next time.
Thanks, everybody. Bye.
Bye-bye.